Yeah, it's another interesting week, isn't it, Carl?
It is. We got an inflation reading that was a little bit lower, but not lower enough to really satisfy the market this week.
Yeah, expected was 8.1. Inflation came in at 8.3, still lower than 8.5, but I don't care who you are. It's not low enough or trending low enough to make a significant difference in individuals' lives. And, the one thing that, we always try to come back to is, are we in a recession? Are we headed for a recession? A lot of clients want to know, are we going into a recession? Because that makes us make different decisions with regards to the portfolio. So let's start right there. Obviously Jerome Powell, we'll kind of get into what he said in just a few minutes. But what are some of the things that we kind of look towards as potential indicators of an oncoming recession?
Well, just to summarize first, we still don't think we're quite there yet. But the main things that we look at are, there are a number of things. People look at leading indicators of economic activity that summarize everything. But the big key things that we look at are, was there speculative, frothy activity in markets or something that could lead to big wealth destruction? And maybe there was some of that last year. Is there inflation? Yes, there's some of that. But the key things that we don't see right now are upticks in unemployment. That's a real significant thing. And then the next significant thing is tightening, significant monetary policy tightening from the Fed in terms of, raising the Fed funds rate or pulling quantitative easing away and tightening it. Now we're on that path right now, but we haven't done a lot of quantitative tightening yet.
Yeah. And to that point, obviously we'll see what happens from the Federal Reserve over the course of the rest of this year and how that really impacts the economy. But I will show something that we were looking at earlier today is the leading economic index or indicators. So this is a conglomerate of economic indicators that we're looking at here that kind of tell us and forecast, how the economy is doing. And what you'll see prior to any recession in the past, if you go back to 2001 on the left-hand side, 07 to 08 right here, and then obviously COVID, is you see this period of rolling over. And we haven't seen that. And if you scroll down to the year-over-year changes, typically recessions occur when that leading economic, I can't even get it out today, Carl, leading economic indicator year-over-year change goes negative. So you can see here in 2000, it went negative, and here in 06, 07, it went negative. And then obviously COVID was, the rare instance where it just barely went negative than COVID. But we're still, fairly high year-over-year positive change on the leading economic indicator index, and we still haven't rolled over. So that's one of the things that we look at. Another thing would be the yield curve inversion, where we got a brief one for about a week, and then it, obviously rates shot up higher. So we haven't had a full yield curve inversion. That's something that you like to talk about, a decent amount of time. But is there anything else other than employment? I think we added 426,000 jobs. So this all leads us to believe that this is just a really nasty correction in the markets. And for individuals that were invested with, Cathie Wood and ARK and those really high speculative names, virtually no earnings or not forecasting earnings, trading at, 20 times their revenue, not 20 times what they're earning, 20 times what their revenue is, those have gotten completely slaughtered.
Right. I mean, there are a lot of stocks that are just down 80, 90%. But those are all companies that don't really have any earnings or cash flow. They're not buying back shares, and they were trading at high prices to their sales. So anything could have happened there. But when it became, realized by everyone that a lot of the sales growth that they were having was due to the pandemic, and it's now slowing down, even though they're still growing, there was a big re-rating in the valuations of those companies.
Yeah, and just like everything seems clear in hindsight, And we get the trouble of bearing that burden as investment managers and financial advisors for clients. In the current moment, there's a lot of things that are kind of perplexed. So we talked about this today with a client that Google currently at its current price is trading at the same multiple as Clorox. Clorox only grows sales by a couple percentage points per year, where Google grows it, somewhere close to 20 or more. And it just doesn't make a lot of sense when you see those things. So when you see these exacerbations, whether they're to the upside or even to the downside, like what we've seen so far this year, it doesn't always mean that it's going to pan out that way. And we talked about, if we are in an inflationary environment, do you want to own companies that are only growing by 2 or 3% or below the average inflation rate? Or would you rather own good, solid companies with good fundamentals, buying back shares that are trading and growing their sales at 15 or 20% a year? And the answer is the latter. That's the smart move to do. And we've made some internal changes. I did want to kind of get to Jerome Powell because he did put out a statement just after the market closed. So we'll see how the market opens on Friday. But what this looks at here is a statement that he made. And he said, Powell says he can't guarantee a soft landing. Well, duh. Right. And
right. That's not surprising.
And odds were absolutely against him. Right. So we're in an environment where the Fed, the only tool that the Federal Reserve has to control inflation is to raise interest rates, slow demand, and slowly contract the economy. And what we're saying with that is that may happen, but we haven't seen any of the indicators of a recession. So we should see, and we still firmly believe that we may get a bounce sometime this year. And that may be a better time to look to reposition. Now, we have been repositioning. We have been getting a little bit more defensive as the year's gone on. But at the same time, it's not very prudent to buy high and sell low. You want to be buying low and selling high. So looking for those opportunities. Anything you'd like to add on the Fed, Carl?
Well, I mean, we're just going to see how far they are able to go and how they do everything. I think an important thing is that they want to be gradual about the quantitative tightening and how that gets ramped up. They decided in the last meeting in their commentary that they didn't want to do it at the 95 billion a month rate.
Right.
In the summer. They wanted to start slow at 47. And so based on all of that, and even if we have a few more larger rate hikes in there and then some smaller ones in the fall, we don't really estimate that there's going to be too much tightening until maybe sometime in the fall.
Right. Yeah, it'll be interesting to see how they react to obviously price differences in the market. Whether that makes them alter their perspective on everything, similar to kind of what they did in 2018. But the difference between 2018 and now is we didn't have 8% inflation. And that's the bigger driver of what the Fed's having to do. And you've already seen mortgage rates go from 2.5 to 5.5 in the matter of 6 months. So that may put a little bit of pressure on housing. But from our standpoint, what we try to do with every client is put together a unique plan tailored to exactly where they're at in their life, and sticking to that game plan and that roadmap is the most important thing when we come into situations like this. But it's interesting to me. You've seen so many risk assets, whether it's the Teledocs, the Zooms, or even the cryptocurrencies, just get absolutely annihilated. Obviously the stable coin issue that came out earlier today and over the last few days, that's obviously been affecting the cryptocurrency market environment. But when I was getting advice to look to crypto from like a barber, that's generally a sign that, it's probably
it's mainstream. It's not
right.
A unique,
so,
different thing.
We're not surprised in those risky bubble assets, but we are actually surprised at some of these good, solid companies that are just getting thrown out, with the bathwater right now. One thing I did want to leave everybody, we're going to leave this link in the comment section. Barron's just put out a really cool calculator because all of us can talk about core inflation. We can read the CPI prints of 8 or 8.5%, but what does that mean to us as individuals? So Like I said, we're going to put this in the comment section, this link. But what this article shows is what's actually in your basket, what's important to you, how much is inflation actually affecting your particular budget. And, Carl and I ran through it really quickly, and it only took, maybe 2 minutes, maybe, Carl?
Right, a couple minutes.
Just
Easy.
as an estimate. So basically what you do, you can put in, what your monthly income is. Let's say it's $2,500, and you can adjust your shelter, how much you spend on shelter, how much you spend on food, how much you spend on transportation. And then what it will do is it will actually calculate what your personal CPI rate is, because that's what's important, right? And that's what we do here. It's on a personal level. It's not just what the CPI print is. So make sure you click that link in the comment section and see what your personal CPI index is. I think that's kind of neat. Anything else, Carl?
I think that's it. We're just waiting to see how things settle down here. We're continuing to reposition thoughtfully, and I think that the most likely thing is that we're kind of, it's just that we're just in a bad correction, and we're probably getting close to the end of it, and maybe things will start to settle down as if some of these technology hedge funds that are down so much are in the process of getting liquidated, maybe the selling will start to slow down, and we'll be reading the news about that in a month or so.
Yeah, I completely agree. Well, until next week, if it don't make dollars, it don't make sense, Carl. I appreciate you guys. I appreciate everybody listening. Make sure you share it with family or friends. And if we can help them out in any way, we'd be happy to. Thanks, Carl.
Thanks, Andrew.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.